Folks, let's talk about investing. I know that word can sound complicated. It can sound like something reserved for Wall Street folks in fancy suits, but that's just not true. Investing is for everyone: teachers, plumbers, stay-at-home parents, and for you. This essay is for anyone who wants to make money work for them, explained in plain, simple English. We will break down the main types of investments, one by one. No jargon, no confusing charts, no get-rich-quick nonsense. Just the truth you need to stop guessing and start building real wealth for your future. Think of it like tools in a toolbox. You wouldn't use a hammer to saw a board. Match the right tool to the right goal. By the end, you'll understand stocks, bonds, mutual funds, the difference between rentals and REITs, and how they fit your goals. We're turning the unknown into the known, together. Beginner tip: before you invest a single dollar, have a written budget and work on getting out of debt. Let's start with the basics, the foundation of any solid financial house: savings accounts and fixed deposits. A savings account is a place at a bank where you can put your money and it will be completely safe. The bank pays you a small amount of interest for keeping your cash with them. A fixed deposit, or CD, is similar, but you agree to leave the money for a set time, 6 months, 1 year, even 5 years, during which you don't touch it. In exchange, the bank usually pays a slightly higher rate than a regular savings account. Say you have $1,000 for emergencies. At 1% per year, you'd earn about $10 over the year. If you won't need it for a year, a 2% CD would earn about $20. Biggest pro: safety. Your principal is protected and funds are liquid, especially in savings. That's why an emergency fund of 3 to 6 months belongs in savings, secure and accessible. Main drawback: returns are low and rarely beat inflation, so they're terrible for long-term goals like retirement. Use them as a parking spot, not a growth engine. Beginner tip: open a separate high-yield savings account just for your emergency fund. The next step up in risk and return is a bond, a loan that you make to a company or a government. You lend money for a specific period, they pay you interest and return your principal at maturity. Example: a 10-year government bond at 3% on $1,000 pays $30 per year, then returns $1,000 at the end. Pro: bonds are generally more stable and predictable than stocks. They can provide steady income and stabilize a portfolio. Main risk: interest rates. If new bonds pay more, your older lower-rate bond is worth less. There's also credit risk. Some issuers may struggle to pay you back, and very safe bonds may not beat inflation long-term. Beginner tip: as you approach retirement, consider adding more bonds for stability. Bonds are the sensible, steady part of your plan. Now, we're talking about real growth. When you buy a stock, also called a share or equity, you buy a small piece of a company. If the company does well and grows, your ownership stake becomes more valuable. Buy 10 shares at $100, other buy dollars. The combined buy. Your total is $1,000. If the business expands and profits rise, the stock could reach $150 per share. Now your stake is $1,500, and you may also receive dividends. Over time, stocks have historically outperformed savings, bonds, and inflation. Owning stocks lets you participate in innovation. This is the engine of your retirement plan. With greater reward comes greater risk. Prices can be very volatile. It's possible to see a $1,000 investment drop to $700 in a bad year. Never invest money in stocks that you'll need in the next 5 years. Beginner tip: don't try to pick individual winners. It's better for beginners to own a wide variety through a mutual fund. Strength in numbers: the power of mutual funds and ETFs. If picking stocks is hard, most people should use mutual funds or ETFs. A mutual fund pools money and buys dozens or hundreds of investments. When you invest in a fund, you instantly own a tiny piece of everything inside. ETFs are similar, a basket of many investments. Difference: mutual funds price once at day's end. ETFs trade all day like stocks. ETFs often have lower fees, which matters a lot over time. Biggest pro: diversification. Don't put all your eggs in one basket. One bad company gets balanced by the other 99. Con: you give up some control and pay fees. Expense ratios: small fees compound. Look for low-cost funds. Beginner tip: seek growth funds with 10-plus year track records and low fees. Within funds lies the simple path: index funds. Index funds aim to own all the stocks in a market index and match its performance. Example: an S&P 500 index fund holds the 500 largest U.S. companies in similar weights. Goal is not to beat the market, but to be the market. Advantage: incredibly low cost, no star manager needed. Over decades, lower fees can mean tens or hundreds of thousands more in your pocket. They're simple, diversified, and deliver the market's average, historically, very good. Con, they drop when the whole market drops. Beginner tip, a low-cost S&P 500 index fund is among the best long-term investments. Beyond stocks and bonds, real estate, direct ownership means buying a house, condo, or small apartment building to earn money. You earn via monthly rent and potential price appreciation, but landlording requires work and significant upfront money. A REIT owns portfolios of income-producing properties. You can buy REIT shares like stocks. Pros, ease, diversification, and lower dollar entry. By law, REITs pay out most income as dividends, steady potential income. Cons of direct ownership: big down payment and responsibility for everything, maintenance included. Properties can be illiquid and slow to sell. Rates trade like stocks, so prices and dividends can be volatile in downturns. Beginner tip: if you're not ready to be a landlord, consider a small REIT allocation to add real estate diversification. Commodities are raw materials, things grown or mined, metals, energy, crops. Unlike stocks, they don't produce anything, no dividends, no interest. Their value is purely market price. You can own physical gold or use ETFs that track commodity prices. Gold can act like portfolio insurance during crises, but commodity prices are volatile, driven by supply, demand, weather, and geopolitics. They shouldn't be the core of your plan. Keep allocations small, if any. Beginner tip: treat gold as insurance, not a primary growth investment. Cryptocurrencies like Bitcoin and Ethereum are digital tokens on decentralized blockchains. They aren't issued by governments or banks. Ownership is recorded on public ledgers. Let's be clear, this is speculation, not traditional investing. Prices are driven by sentiment and hype. The hope someone will pay more later. Some made fortunes. Many more lost big. Sometimes life savings. It's the most volatile asset class. Huge swings in short periods. It's largely unregulated, complex, and produces no income. Treat it like a trip to the casino. Risk only money you can afford to lose entirely. It should not be part of your core goals like retirement, college, or a home. Beginner tip: do not invest in cryptocurrency. If you choose to ignore this advice, only use a tiny amount you could set on fire. Tying it all together, how to choose and build your plan. Step 1. Clarify your goal and timeline. Short-term goals need safety. Long-term goals can use stocks for growth. Be honest about risk tolerance. More bonds if losses keep you up at night. Diversify across company sizes and regions with a few low-cost funds. Next steps: build a 3 to 6 month emergency fund, pay off debt, invest 15% for retirement, and automate contributions. Start small, be consistent, and let compounding work. Create a written plan, review yearly, and ignore daily headlines.